So let's get started. So this session is going to be talking about crypto data. And here with us, we have Ombre and Clara from Kaiko. And they have a pretty exciting presentation that I think everyone's going to really enjoy. And they're going to be able to get into the nitty-gritty data details that I think we also enjoy. So if you two are ready, I'll pass it off to you guys.
Yeah, thanks a lot, Mason. And hi, everyone. Happy to be back here on Mainnet. My name is Ambre Soubiran. I'm the CEO of Kaiko, and I'll introduce Kaiko, and then Clara is going to present a kind of suite of data products related to order book data. So a bit about Kaiko first. So we've been founded in 2014. We're a crypto data provider, and we address pretty much any market participant with market data related needs. We do the collection, normalization, storage, and distribution of market data. We have a different set of APIs to make this data available in a neat and normalized fashion to different market participants. We cover everything going from tick level trades to detailed order book data. And using that raw normalized data, we create a bunch of data analytics and aggregates that we also distribute to the markets. We cover over 85 exchanges currently globally, and that encompasses over 35,000 instruments, including spots, futures, derivatives, perpetual swaps, anything that trades anywhere, we will cover from a market data perspective. Our team is based in Paris, and we have an office in New York and an office in Tokyo. So if you can just see the slide here, it's just a very high-level overview of our stack and how we do what we do, which is we're integrated to the APIs of all cryptocurrency exchanges around the world. We do the data collection piece. We then have a data pipeline that does the ingestion, deduplication, normalization, storage, all the analytics, aggregations, and creation of flat files in our pipeline. And yes, sorry, little detail. If you need to enlarge the slides, you can just double click on the slide. You should be able to see on the screen, and you'll have it in full screen. And then once we have this kind of clean data, we deliver this data. We have a couple of products for that. One of them is the data feed, which is a flat file delivery service. We have a market API, which is a standard REST API, but rather than connecting to all the different exchanges APIs, you could collect through us and access all exchanges data. And we have a WebSocket API that delivers real-time trades. So this is just a high-level overview of what we do at Kaiko. And for the rest of this session, we want to focus on order book data and why and how it's important to leverage that data. So I'll pass over to my colleague Clara for the rest of the session. And then if we have some spare time, we will be both very happy to take any questions. So feel free to post any questions in the session chat on the right-hand side of your screen. Over to you, Clara.
Great. Thank you, Ambra. Hello, everyone. I'm Clara. I'm normally in Paris. Right now, I am in Cleveland, Ohio, still at my parents', but I will be returning to Paris, hopefully in the next few weeks, where I work at Kaiko headquarters. But before we get started, it's going to be a really great presentation on how to leverage our order book data to study market liquidity. But I really want to introduce our newly launched tick level order book product. We have our official announcement this Wednesday, but I just want to give the Messari viewers a special sneak peek. So we have always collected order book snapshots, which include all bids and asks on an order book at a given moment of time. However, over the years, we've gotten more and more requests for higher precision order book data. So what this means is tick level data, or every changed, added, or removed bid and ask to a trading pair's order book. So this is incredibly granular, the highest quality data in the industry, and it's time-stamped and non-aggregated. So we just began collection for tick level order books from Coinbase, Bitstamp, and Bitfinex. And it really does provide you the unmatched ability to replicate these historical market states with tick level precision. So no one has this data. It's really for the most professional traders, but we really we're excited about it, and we want to give people the opportunity to test it out. So please email us at hello@kaiko.com if you do want a 2-week free trial. It's truly the most sophisticated data you can get, and we're excited to launch it this Wednesday. But moving on to our presentation. So this presentation is about liquidity and how you can leverage order book data to study different markets on different exchanges. So first, before we get started, what is liquidity and why is it important? Right now, I would say the most commonly used measure of a market's liquidity is the trading volume. However, this has historically and notoriously been an unreliable measure. Today, I want to expand on the concept of liquidity to explain why order book data is required when assessing these markets. So liquidity is defined as the degree to which an asset can be exchanged on a market at stable prices. And when you're only looking at trade volume as an indicator of liquidity, we actually ignore a really crucial aspect of this concept, which is price stability. Order book data allows traders to study the effects of large market orders on the price of an asset. With trade data, you can't see whether a large market order will actually be able to be absorbed by this market. With order book data, you can measure the impact of large market buy or sell orders on the actual bids and asks of an order book. So by measuring market depth, price slippage, and spreads, we can better understand how easy it is to exchange an asset at both stable and ultimately market-driven prices. So the three measures we're going to look at today are market depth, price slippage, and the bid-ask spread. And all three of these measures are derived from our current raw order book snapshot data product. So market depth refers to the quantity of bids and asks on an order book. The more bids and asks on an order book at a range of price levels from the mid-price, the easier it is to exchange an asset at stable price levels. Market depth can be measured at different ranges from the mid-price. For example, if you want to measure the 1% market depth, this would be the sum of all bids and asks at plus or minus 1% from the mid-price. So by studying patterns of market depth, we can ultimately determine how market makers are behaving on a market and study the liquidity of various markets. So generally, the deeper the order book, which is the greater the depth, the more liquid the market. So the next measure is price slippage, and price slippage is very closely tied to market depth. So price slippage measures the difference between the expected price of a trade and the price level you arrive at after fully filling the trade with the bids or the asks on an order book. For example, if a large market order causes significant price slippage, this implies that there was actually not enough market depth to fully support an order of that size. Price slippage occurs as an order is filled at more than one price level. So a large order essentially eats through an order book as bids or asks, depending on whether the order was a sell order or a buy order, are filled. So again, how it relates to liquidity, the higher the slippage, generally the less liquid the market. And finally, the last measure we're looking at is the spread, which is the difference between the best bid and the best ask. And in terms of liquidity, generally the narrower the spread, the more liquid the market, and the wider the spread, the less liquid. So the first chart we have here, we charted market depth on 4 top exchanges. We have Bitfinex, Bitstamp, Coinbase, and Gemini. So you can observe that some exchanges have deeper order books than others. In this chart, we see that Bitfinex, the BTC USD market, has a far deeper order book than Gemini's. So market depth, again, is closely associated with an asset's liquidity. Markets with deeper order books, such as Bitfinex or Coinbase, are better able to sustain large market orders with little impact to the price. And so this, again, is a sign of liquidity. So as you can see in this chart, you can also see how as the price changes, which is the blue line, market depth adjusts. We can observe here that as the price rose, market depth actually declined on the BTC market. So why did this happen? Market orders generally increase during a price rally or crash, which means that market makers who are supplying liquidity to these order books must readjust their positions. And they do this to account for the changes in the supply and demand that the price takers, for the price takers. So for example, when the price rose, the market makers were adjusting for this increased risk, and thus there were actually fewer bids and asks on the order book for a sustained period of time. So in general, this was a particularly volatile price period. In times of volatility, the market depth tends to decline because market makers need to adjust for this increased risk, and it takes time for them to readjust their positions. So let's zoom in a little bit on a market microstructure. So here I charted the bid depth and the ask depth of Coinbase BTC USD, And the red line is the ask depth, and the green line is the bid depth. And below we have the gray line, which is the price of Bitcoin. So we see some really, really interesting movements on this chart. This was from May 19th, where the price of Bitcoin rose really quickly. So here you see a very, very quick price rise over about 30 minutes, and it holds stable for a bit and then slowly falls. However, we can see that as the price rose, we observe a sharp divergence between the sum of the bids and the sum of the asks, placed within 2% from the mid price. And as the price fell, it was stable and it stayed the same. But as the price fell, we see another divergence between the ask depth and the bid depth. So what's actually happening here? The divergence can be explained again by the behavior of market makers and how they adjust for risk in the changing behavior of price takers in the midst of price volatility. So as the price rose, we see here, we actually get an influx in asks added to the order book. And as the price fall, the asks decline and the bids rise. Ultimately, market makers are supposed to provide liquidity. That's their job. They have to provide liquidity to these order books. To do so, they are actually keeping up with the supply and demand of price takers on the other side. So when a lot of price takers are placing buy market orders, then the market makers will place more asks and vice versa. So now let's look at market depth during a price crash. So this was during, of course, the notorious Black Thursday price crash in mid-March. So in price crashes, normal market maker behavior gets completely turned upside down. We'd never seen such destructions to an order book before as we did during this Black Thursday price crash. So during this price crash, the price fell about $1,000 in record time, and you can see a corresponding depletion in the order book. So as selling pressure built right towards the beginning, the bids and asks on the order book started being rapidly removed as price takers were buying and selling during the price volatility. Ultimately, market makers were very much caught off guard during this price crash. In particular, because it was unique, it was caused mostly by a lot of BitMEX liquidations on top of a real exogenous event, which was the coronavirus. However, the liquidations really pushed the decimation of order book depth to extreme levels. And again, you'll see here, it took time for market depth to build up again, and it was still pretty volatile because there was actually a second price crash that happened later in the day. So why is market depth important? Ultimately, the depth of an order book can have a big impact on the price. If I had charted price here, you would have seen a rapid fall in price as depth was decimated during this time frame. So as market orders are taking bids and asks off an order book, this can push down the price. So let's move on to our next measure, which is price slippage. So you may sometimes wonder, why do institutional traders only trade on don't trade on exchanges and only trade over the counter? So the reason is price slippage. Price slippage measures the percentage change in price that results from a large market order. So price slippage is very closely related to depth because it is calculated from the bids and asks on an order book. Price slippage can be simulated of orders of any size, and it's calculated using raw order book snapshots. So in this chart, we calculated the price slippage on BTC USD markets for 8 exchanges. So we have price slippage for a $50,000 sell order. So when you're calculating price slippage for a sell order, you're running this fake order through the bid side of an order book because a sell order refers to the price taker or the market order that is being placed. So the market order is filled by the limit order, which is on the order book, and it's filled by bids. So we calculate this sell order by running this imaginary order through a real order book snapshot. And what we get is a percentage, and this percentage is the change between the expected price, which in this case is the mid price, and the price level required to fully fill the $50,000 order. So we can see here that price slippage varies based on the exchange, and some exchanges have consistently higher price slippage than others. We can observe here that Bitflyer has consistently higher price slippage than Kraken, which tends to be a more liquid exchange. So now let's look at price slippage for orders of different sizes. And of course, the larger the market order, the higher the price slippage. So here I charted an order size of 10,000, 25,000, 100,000, and 500,000. And I ran these orders through BTC USD order books on Coinbase. And of course, there is a perfect correlation. The smaller the order size, the lower the price slippage. And the higher the order size has pretty high price slippage. And of course, this is very intuitive because this data is calculated directly from market depth. So the larger orders will eat through the bid side or the ask side of an order book more so than smaller orders. And finally, let's look at price slippage in altcoin markets. Price slippage is generally higher in altcoin markets because there are fewer market makers providing liquidity to these order books. In this chart, we compare price slippage for BTC USDT and 4 altcoin pairs on Binance. As expected, the price slippage is very low for BTC USDT, which is actually one of the most liquid pairs in the whole cryptocurrency industry. And then you compare that to 4 other altcoin markets, which are quite a lot higher. So we're just going to do a plug for Messari's price slippage screener right now. It's actually built using Kaiko slippage data. So what's cool about their slippage screener is that it aggregates all of our price slippage data across all exchanges. So we provide exchange pair slippage data, but they take an average of all of this data, and you can calculate price slippage for assets as a whole. And this is a great holistic measure for measuring the liquidity of entire assets. So definitely check this out on Messari's webpage. It's live, it pulls directly our API, and it's pretty cool. So the last measure we're going to look at today is the bid-ask spread. So the spread is the simplest indicator of a trading pair's liquidity. And of course, again, it tends to differ based on the exchange. So the spread, again, is simply the difference between the best bid and the best ask. And the narrower the spread, the more liquid the market. So why is that? Again, it has to do with the complex interaction between price takers, market makers, and market depth of a pair. So pairs with a currency pair with lower market depth typically means that market makers are taking on more risk when they provide liquidity to these order books. Pairs with lower market depth are more risky, and so the market makers need to adjust the spread accordingly to account for the increased risk. So they will widen the spread on low liquid markets. And then conversely, on very liquid markets where there are plenty of market makers to absorb the market orders of price takers, a lot of terminology here, I know it can be a bit confusing, but spreads will be thinner on these markets because there is simply less risk that market makers need to account for. So again, we've charted the spreads of Bitcoin, Ethereum, and XRP on 8 exchanges. And you'll see, again, that it really differs by exchange. And this has to do, again, with some markets are more liquid than others. So let's look at spreads on altcoin markets. Altcoin markets tend to be less liquid than BTC or ETH markets, with varying degrees of liquidity across pairs. So here I charted 3 altcoin pairs on Coinbase. And just to compare this measure to trade volume, which is the most commonly used measure for liquidity, I perform a liquidity ranking. So you'll see this little box here. This is the raw data because it's a little more difficult to visualize. But you see that there is a perfect correlation between the spread and the volume. The pairs with the higher volume have the narrowest spreads and vice versa. So right now, EOS USD can be ranked according to this ranking, the most liquid out of the 3 pairs, while Dash USD is the least liquid. So we performed the same analysis on derivatives markets. I took the spread and the traded volume for 3 contracts, the June, September, and December Ethereum contracts. And we again find a perfect correlation between the expiry, the trading volume, and the spreads. So this, I think, is a really, really good example of natural market forces at work, showing that higher volume contracts are almost always the contracts closest to expiry, which is why the June contract has the highest volume, and conversely, the lowest spreads. Meanwhile, the December contract is very far off, and so it has very low trading volume, and it has the highest spreads. So this is our last slide, but just to conclude, why is order book liquidity important? Helps create healthy markets, enabling superior market-based price discovery. So what does that mean? I think, again, we can take a look at the coronavirus-induced price crash of March, Black Thursday, and we can see how during a price crash, a deficiency in order book depth ultimately led to a continuous negative feedback loop where continued decimation of order book depth continuously pushed the price of Bitcoin down. And we call this automatic selling pressure because there was, in fact, a real natural exogenous event that caused the sell-off. But after BitMEX liquidations, this triggered a relentless feedback loop of falling prices, which ultimately pushed down the price, I would say, unnaturally because of these mechanical quirks in the crypto industry. So ultimately, order book liquidity is really important because it creates healthy markets. And we think order book data is important because it helps researchers and traders study these markets. So thank you very much. I guess if we have extra time, Ambra, do you want to maybe step in? I don't see the screen right now. So if there are any questions or if you have anything
Clara.
to add, go for it.
Super interesting. Thank you so much. I guess there were a couple of questions, but you addressed some of those during your talk. Can you see the chat on the side? There's a couple of session chat about, so what about traders who don't have open orders, but watch an exchange API and create an order during heavy volume events? It's Jonathan from Basari, who's referring to something like shadow order books, as in, are there, I guess, ghost orders that only come up at the last moment?
Yeah. Yes, there are. And that's another reason why we started collecting tick level order book data. So we miss in between. Of course, high frequency traders place a lot of millisecond orders that get executed almost the second they're added to a limit order book. And so our current order book data does not capture these microsecond, millisecond orders. So yes, we do not, sometimes our order book data is not perfect, our snapshot data, which is why we've started collecting tick level data, and you will actually see every millisecond order placed to the limit order book in our new order book data product. So yes, there are occasionally ghost orders. And of course, every exchange has a different matching engine. So some exchanges only match market orders with limit orders, but other exchanges sometimes will occasionally match limit orders with limit orders. And it really depends on the matching engine of the exchange.
And so Warren is asking, not sure on how you can apply this to trading. And do you have any suggestions? My 2 cents, but I'll let Clara, add on top of that if you have anything else. But I think it's very important to monitor actually like real-time slippage, market depth, spreads. All of these metrics are basically derived from the order book data and can be quite painful sometimes to consume. Trade data is a very straightforward data set that people are used to. It's a time series data set. You get it every time there's a new trade, it pushes the previous one away. And we know how to leverage price data, right? But order book data can be more cumbersome. It can be incredibly heavy in terms of the amount of information to consume in real time. And so I guess to your question, Warren, what I would do is, whenever I trade and whenever I make trading decisions, there's kind of the pre-trade risk management of where do I execute that order in order to get the better price. And the better price is not just a function of the price. It's also a function of the kind of microstructure of the exchange. So I guess that's how I would integrate that into a trading strategy. And then there's kind of the post-trade analysis as well of looking how my order impacted the order book structure and how stable is the exchange. I think this notion of stability that Clara mentioned is incredibly important when addressing crypto markets. It's still relatively unstable, as we can see during price crashes.
Yeah, and I guess to add on that, it's really important, I think, to study market microstructures if you're a trader. A lot of the trading signals you see only rely on volume and price data, which is purely trade-based market signals, whereas the most interesting things are happening actually on the order book. And this is, again, the market microstructure. It's different for every single trading pair. So simply studying one order book snapshot, you notice things that you would never get by just looking at price data.
There's another question about latency. I think latency is not, it's very important, of course, to not be like 3 days late, but I think latency for the order book data, it doesn't change in a millisecond either. For all the kind of endpoints around liquidity, slippage, spreads, all of that, we update twice per minute. Clara, correct me if I'm wrong. And then the L3 order book will be available at the tick level. And that will be kind of every single ticks. But for all the real-time liquidity metrics, this is updated twice per minute. And end is available. I think it's important to note because we focus a lot in all of those talks and conversations on the Bitcoin and ETH markets. But all of these endpoints are actually available for over 35,000 instruments, including derivatives and futures and options. Everything that Clara presented is available for any instrument that we cover. And the actual full coverage list can be available on the Instrument Explorer. You can see the link on the bottom left-hand side of that slide, instruments.kaiko.com. That is actually a very useful tool for people to search the kind of global list of instruments that are being traded everywhere. Do we cover Latin American markets? I think we cover BITSO.
Yep,
we don't sort exchanges by region, but Hector, if you want to reach out, I'll happily look into that for you and give you an answer. But if you go on the instruments.kaiko.com, you'll see the list of all the exchanges that we cover. We cover above 80 exchanges. All right, sorry, I'm going through the question. Yeah, don't hesitate to reach out. By the way, anyone for any question, feel free to reach out. Clara@kaiko.com, hello@kaiko.com. All of the information are available on our website, on our API documentation. You'll see the coverage. There's a little filtering tool on the top right-hand side of the Instruments Explorer where you can filter every single instrument. But don't hesitate to reach out. Hey, Bitso. Cool. I think we're 2-3 minutes early. If there's any, is there a way to attribute order book limit or market orders to specific accounts or wallets? Unfortunately not. And actually, I don't know. I guess it's fortunate as well. We don't have any GDPR issues. We don't have any wallet information. It's pure market data. So we have, time, volume, price, trade direction. We have plenty of information, but it's absolutely not tied to specific accounts or wallets. Best options exchanges. We've been actually writing a couple of articles using Deribit's market data, which we think is very good. Clara, I don't know if you want to comment on that, but yeah, recently. Yeah, happy with Deribit.
Yeah,
I mean, BitMEX historically, of course. But recently we've heard a lot of noise and we get a lot of requests for Deribit data. You can look up on our blog. I think it's blog.kaiko.com. And you'll see there's a 2-part article that does a in-depth analysis of the Deribit options market data. And if you're interested in that, you should find it interesting. Do. All right, so I guess we're going to leave it for our colleagues from Flipside in a couple of minutes. So thank you very much, everyone, for tuning in. And yeah, feel free to reach out. We'd love to talk. And I guess we'll leave the room over now.